There's a new issue that's beginning to emerge for the US consumer within the auto sector of the market, which is called negative equity. If you go to trade in your car for a new car and your auto loan balance is larger than the value of the car itself, you have to find a way to settle that up. Some people will either have to write a check when they go to get their new car to pay off that old loan balance, or they'll roll it into their new car loan. The really concerning part is the rate that these negative equity events are growing at. If you look at this chart that was put out by Edmunds, back in April 2010, 22% of all trade-ins had some type of negative equity event. You fast forward just 10 years to April 2020, 44% of all trade-ins were in a negative equity situation. And also the dollar values of those negative equity events have grown as well. Back in 2010, the average was about $3,700. By 2020, it was now $5,500. There are a number of factors that are contributing to this trend, but number one is a car is a depreciating asset. It decreases in value as time goes on. So it becomes this horse race between how quickly is that car decreasing in value versus how fast are you paying down the loan. If there's a mismatch between the two and you go to trade in your car and your car is worth $5,000, but your loan is still at $8,000, you have a $3,000 gap that you either have to write a check for or you have to roll that $3,000 into your next car. But for car buyers that decide to roll over that $3,000 worth of negative equity into their next loan, they're already starting further behind when they purchase the next car because it's a larger loan to pay down, which could leave them with even a bigger negative equity event when they purchase the next car. Now let's compare that loan situation to an asset that appreciates in value, like when someone buys a house. So a house historically appreciates in value slowly over time. So you buy a house for 300 grand, you take out a $300,000 mortgage, you would expect slowly the value of the house to go up while you're paying down the mortgage, and that gap that's being created is increasing, hopefully, your net worth. When I'm consulting with younger professionals, I often advise them as much as they can to stick to a 5-year auto loan and not be tempted into a 6 or 7 year duration auto loan. Yes, stretching out the duration lowers the payments and makes it more affordable, but it also increases the risk that you're going to end up in a negative equity event down the road. Let's look at a real life example of this. Let's say you want to purchase a car that's $40,000 with a 3% interest rate. If you decide to go with a 5-year auto loan, your monthly payment will be $718.75. If you decide to stretch that out to a 7-year auto loan, the monthly payment drops to $528.53. The obvious appeal of the 7-year is the monthly payment is almost $190 less than the 5-year. But again, it also increases the probability that if for some reason you have to turn in that car earlier than expected, you could have negative equity because you're paying that loan down at a slower rate. Plus also factor in the interest. If you compare the interest of the 5-year loan versus a 7-year loan, you're going to pay an additional $1,271 in interest over the course of that 7-year loan. The main objection I get is this: well, my cars last a lot longer now than they did 10 years ago. So yes, 10 years ago, 5 years paid off, get a new car, but now cars are reasonably lasting 6, 7, 8 years. So it justifies stretching the loan out longer. And while I agree that cars are lasting longer, that does not prevent the life events from happening that then prompt people to turn in those cars before they're done with that 7-year loan payment that puts them in those negative equity situations. And some of those situations are, not everyone is going to want to keep their car for 7+ years. It's not uncommon for car owners to get bored after 3 or 5 years and want to turn in their car before their auto loan has been paid in full. And you have to remember, your car depreciates by the most within the first 3 years of owning that car, which could put you in a negative equity situation. Number two, if your car breaks and you're out of the warranty period and you have to make an expensive fix, you might decide, well, instead of continuing to make fixes, I'm going to turn this thing early and just buy a new car. Number three, your family size could change. You could have more kids and realize I need a bigger car. You could move to a different climate saying this car is not going to handle good in the snow, or I want a convertible because I'm moving down south. Another one is you could move to a major city and realize I don't need a car in a major city, so I'm going to sell this thing. Or the last one is you could get an accident and total your car and the loan is still outstanding on it. So you could again end up in this negative equity situation. The moral of the story is this: it's tough enough to know what's going to happen next year, let alone what's going to happen over the next 7 years that could change your plans for when you're going to buy your next car. You have to be very careful about this rolling negative equity strategy. If you roll negative equity in your first car, then your second car, then your third car, that snowball is going to keep getting bigger and bigger until eventually you're going to hit a wall. And the bank's going to say, hey, we are not going to lend you enough to both purchase the car and roll this huge snowball of negative equity in the next one, and then you're stuck. Even though you may plan on owning that car for more than 5 years, I'm still a huge fan of taking just the 5-year car loan, because at some point you may have no car payment, and that's a wonderful situation. You're used to sending, let's say, that $400 to the bank every month for your car payment. Now all of a sudden that's done, and you can take that $400 you're not used to having and put it towards another financial goal, like paying down debt or putting it towards retirement or saving for college or something else to advance other parts of your overall financial plan. Remember, the best financial decision is usually not the easiest one to make. When you're looking at the monthly payment for that 5-year versus that 6-year, it's going to be tough not to resist that urge to want some breathing room and go with the 6-year, but you will thank yourself down the road giving yourself some more equity in that car, that when you go to trade it in or when one of these life events happen, you're not staring down one of these negative equity situations. There's a post-COVID trend right now that's both helping and hurting the situation. Helping in the short term in that when people are going to trade in their vehicles, they're getting really, really high amounts for their trade-in, which is now covering their loan that it might have not otherwise done that 2 years ago. So it's helping them avoid those negative equity events. But the flip side of that is they're then purchasing a car at a very inflated level, taking an auto loan for 6 or 7 years on that inflated level. And they might find at the end of that loan that the car is not worth what they bought it for 6 years ago because there was a shortage of supply. I hope this was helpful. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.